The stock price for Opendoor Technologies Inc., Open, is currently $8.23.5, reflecting an intraday decrease of minus 3.00% as of 11:59 a.m. Eastern Daylight Time on October 9, 2025. Now, most investors see this kind of drop and immediately think housing market pressure or iBuying model inefficiency, especially given the recent run-up in the stock. The market narrative has been all about this phenomenal gain of over 380% in the past year, fueled by a speculative near-meme stock enthusiasm and the belief that they've finally cornered the iBuying process with superior algorithms. However, the reality is far more complex than a simple sentiment-driven swing. The most immediate, unexpected twist here is that this downturn today isn't primarily about the housing market's macro environment, which has actually shown some surprising resilience in certain pockets, but rather a direct consequence of a significant shift in institutional selling pressure that has overshadowed any good news. Specifically, a closer look at the institutional activity shows a continuation of the trend from the second quarter of 2025, where behemoths like BlackRock Inc. and Vanguard Group Inc. significantly reduced their holdings. This quiet, massive selling by sophisticated entities is creating a heavy overhead supply that the retail buying frenzy, often driven through platforms like Robinhood, SoFi Invest, or a simple individual brokerage account, simply cannot overcome on a daily basis, forcing the price lower today. The expectation is that the stock is moving on retail chatter and macro optimism. The reality is that the largest shareholders are quietly exiting or reevaluating their positions in a way that suggests a fundamental concern with current valuation. The general belief among many retail traders, particularly those who participate in online investing communities and utilize services from Interactive Brokers or Fidelity, is that Opendoor's recent price action, with its spectacular 52-week run from lows near 50 cents to recent highs of almost $11, signifies a fundamental return to growth and a path towards sustained profitability. They see a company that has successfully weathered the worst of the interest rate shocks and inventory woes of the last few years. This expectation is rooted in the narrative of a leaner, more efficient operation armed with powerful artificial intelligence to accurately price homes and control costs. But this optimistic viewpoint clashes sharply with the deeper reality of the company's financial structure and analysis consensus. Look at the numbers. The consensus analyst price target is aggressively low, hovering around $1 to $1.50, suggesting a potential massive downside from the current level. This isn't just one outlier analyst being negative, it's a median target that implies the stock is wildly overvalued by traditional metrics. For a company that continues to post significant net losses, even while beating conservative EPS estimates, and is not projected to reach profitability until at least 2027, the stock's current valuation, near a $6 billion market cap, puts a tremendous amount of pressure on future execution. You see this kind of divergence, spectacular stock price performance versus dire analyst targets, in highly speculative or transitional companies. It tells you the stock is trading almost entirely on future hopes and technical momentum, not on current financials. Today's pullback, therefore, serves as a sharp reminder that the technical strength is brittle and highly susceptible to profit-taking and institutional skepticism. The high beta of around 3.58 indicates extreme price volatility, which is excellent for short-term trading on platforms like Robinhood, but an undeniable structural risk for long-term holders. A key factor driving this tension between expectation and reality is the company's ongoing transition. Opendoor's core business model is centered on iBuying, which involves using proprietary data and algorithms, often referred to as an automated valuation model, to instantly offer cash for homes, closing the transaction quickly, performing light renovations, and then reselling the property for a profit. The market expects this to be a predictable, high-volume arbitrage opportunity. The reality, which they are now openly acknowledging and attempting to fix, is that this model is extremely capital-intensive and highly sensitive to both housing market fluctuations and interest rates. When mortgage rates shoot up, inventory turnover slows down, and the cost of holding properties, property taxes, utilities, insurance, eats into margins, turning a projected gross profit into a significant net loss, which we've seen on the income statements repeatedly. In response, opendoor is shifting towards a more capital-light model, expanding their service offerings to include agent partnerships, dubbed key connections, and a cash plus hybrid product, which mixes a cash offer with a traditional market listing. These are attempts to capture service fees and commission-based revenue, which are much less taxing on the balance sheet. The market is cheering the idea of a capital-light future, but the reality is that these new, lower-risk revenue streams are currently a small fraction of their overall sales, which remain overwhelmingly driven by the old, capital-heavy home sales. Furthermore, these new services put them in direct head-to-head competition with traditional real estate brokerages, diminishing their distinct iBuying identity and adding new competitive hurdles. The question for anyone using an online investment platform to allocate capital is whether opendoor can execute this strategic pivot fast enough to justify its inflated valuation before the next housing cycle downturn hits.
video pretty quick before we get to jam. Um, so one thing that I wanted to do with this video is just to explain that